So we have setup number 1. We have 1, then 2, then 3, liquidity grab, break of structure, and then return to order block. So when you are analyzing the market, then you realize for the structure or this pattern is forming. The first thing that you have to do is to identify your order block. Your order block basically is the last down candlestick that is opposing this impulsive move. That's your order block. So when you identify your order block, make sure that you choose the last down candlestick or the last up candlestick that is opposing the impulsive move. And then we said to validate your order block, you need break of market structure. So the impulsive move from this order block, it goes up, it breaks what? This previous high. So it means whenever you choose your order block, make sure that you choose the last down candlestick, it has what? It has break of market structure. The other thing that you have to add is what? It's SH. SH is manipulation to collect liquidity. So for example, if we have a low in Siana, and then the price manipulates this low, break a structure. It shows what this thing is not break of market structure. It's just the stop hand. The price is just collecting liquidity below this low. And then so this is a basic smart money setup. We have what? We have impulsive move up, we have break of market structure, and then we have SH. So with SH, if your SH is above your order block, or SH, but if your SH is the order block, you can call this thing QML. You can call this QML, and then you extend this line. Even now you're in clear half. So if your SH is the order block, you can extend the line here, even in QML kind SH. So, and then wait for the price to return to your order block. Wait for the price to return to your order block. 1, 2, 1. Price will tap inside our order block, then we buy. When you buy, your take profits. Your take profits is supposed to be this high. Your stop loss, it has to be below your order block. You just have to create a room for manipulation. And then stop loss are the nagai, order block. So this is a basic smart money setup. So to make the setup for in a high probability setup, you have to add confluence. You have to add confluence. So when you add confluence, it's either you use 3D or you use inducement. It's either you use 3D or you use inducement. So 3D is whereby you will connect a straight line, it connects 1, 2, and then the Tashikai block. So it can be 1, 2, and then maybe the price just induces at this point, and then wait for the third touch. 1, 2, 1, then buy. So that's 3D. 1, 2, 3, then we buy. 1, 2, 3, then we buy. So that's 3D. So 3D is a confluence factor. It's a confluence factor. So it's either you use 3D or you use inducement when you are analyzing 3D or inducement. These are the two confluence factors that we have. So with inducement is whereby we have accumulation of retailers so that the price can collect liquidity. So for example, if we have this equal loss here, it's accumulation, because in retail trading, there's what we call double bottom. So if we have a double bottom, 1, 2, it means we have what? We have the stop losses that are resting below this level. So the price has to collect the stop losses. And when the price collects the stop losses here, guys, order block, then we buy. So it's a complex factor because we know that the price has to collect this liquidity. The price has to collect liquidity in order to move. So the price has to take out the stop losses and then it can move up. So inducement, it depends. It doesn't mean for always test to be equal highs. Sometimes it can be relatively equal lows. It can be equal lows or relatively equal lows. Or it can be a low, one. We still call it inducement. So it's either use inducement. If inducement is CEO, then you can use 3D. If 3D CEO, then you ignore it. Because you can't trade something that's not confluence. Always trade a setup where you just confluence. It's either your confluence in 3D or in inducement. It's either confluence or 3D or any inducement. So now let's dive into the chart so that ke kgone go tlhalosa gore ke bua ka eng exactly. Gore ke kgone go tlhalosa gore ke bua ka eng exactly, let's dive into the chart. Gore ke kgone go tlhalosa gore ke bua ka eng. So with SH, it doesn't mean for always you have to look for stop hunt. Sometimes you can just use an order block where stop hunt. It just break of market structure hell. So now let's take an example with the Euro AUD. So with Euro AUD, this is what we can see. So when we identify our order block here, it has to be this last down candlestick. So this last down candlestick, it caused this aggressive move up, and then a break at this previous high. After that, we have inducement here as our confluence factor. So you can see that we have this low, and then the price has to take out this liquidity below this low. Remember what is liquidity? Liquidity in the market is defined by the stop losses. Where we have the stop losses, that's where we have liquidity. So if we have liquidity below this low, the price has to take out this liquidity in order to move up. So if unosabona 3G, you can use what? You can use, if you sabona inducement, you can use 3G. So with 3G, this is what we have. So we have touch number 1 here, the price went up. Touch number 2, the price went up. Then wait for the third touch here. So it's 1, 2, and then wait for the third touch. Let's see. And then this is what we have. So 1, 2, and then the touch blue. So it doesn't mean what if you have your 3D price sometimes price is not blue. For me concept in 1, 2, 3. If no someone 3D, we have liquidity from here to here. That's liquidity. So liquidity in this form, we have inducement. 1, 2, liquidity below this low. The price takes out liquidity and then it went up. So that's about the example. Example number 2. So let's try this one. So example, our order block as the last up candlestick before what? This downwards impulse. So that's our order block. And then the next thing is to identify BOS, break of market structure. Break of market structure to the downside. Break of market structure to the downside. And then the other thing is to identify SH, stop hunt. So we have touch number 1, touch number 2, touch number 3. The price was selling. And then look at this accumulation. It means the price was taking out the stop losses from what? From this accumulation again. So we have 1, 2, 3. That's a valid resistance, and then manipulation of this resistance, price a bit drop to the downside, break of market structure. So the other thing that you can do is to add confluence. The other thing you can do is to add confluence. So with confluence factor, we have this inducement. We have this inducement. What's up here? We delete. EU. So we have SH, we have break of market structure, then we have inducement. Then lastly, wait for the price to return to order block. So you can refine this order block. If order block, you can refine it. So when you refine your order block, order block is still fine, and I'll move 15 minutes. Then you wait for the price to return to order block. 1, 2, and then look at this. 1, 2, price available at this position, which means we had inducement. The price takes out liquidity from this inducement zone, and then look at the end. The price drops to the downside. That's setup number 1. That's setup number 1 plus confluence factors. So after the setup, you have to make sure why it's hard setup way, because that's basic smart money. If you don't understand setup number 1, it means our market. So this one is a must for always one. This one is a must for always one. That's why I can make a sure about the example is it. That's why I can make a sure about the example is it. So talk about the example we have. So let's try this one. No, this one is not a high probability setup. So what about the setup? Oh, this one is B. So let's use this one. Let's say you are analyzing Euro AUD again. Then you realize you have your order block at this position, because it's the last down candlestick before this aggressive move to the upside. So after this order block, we have what? We have break of market structure. We have break of market structure, and then the price returns to order block. Then you have to do what? So we have an order block, we have break of market structure, and then return to order block. So you have to add confluence. So your confluence factor is what? Is inducement. So order block, break of market structure, inducement, then wait for the price to return to order block. You don't need for sometimes you can just use an order block with what? With break of market structure only. And then wait for the price to return to that order block, then you buy. So you can still refine when you go 5 minutes. So 5 minutes, the order block is still the same. And then the other thing that you can use here is it's SH. So we have SH, we have break of market structure, we have inducement. Then let's wait for the price to return to order block, then we can buy. Your stop loss is supposed to be here. Your stop loss is supposed to be here, and then your take profit, you're going to spare you again. You're going to spare you, we have liquidity. So you have to understand the concept of liquidity. Or what is liquidity in marketing? Liquidity is defined by the stop losses. Where we have the stop losses, that's where we have liquidity. So even when the price is buying here, when the price is selling here, it's available to take out the stop losses from this zone. When the price is buying from this order block, it's available to take out the stop losses from this inducement or double top position. So in other words, liquidity is the price magnet. Liquidity is the price magnet. Liquidity, it is what drives the market. So when the price moves, we have to take out liquidity. So when we buy here, aim is to take out this liquidity. And then when the price sells off from here, the aim is to take out liquidity from this inducement point. When it takes out this liquidity, it taps into our point of interest, which is our order block. Then we buy. Then I said, if your SH is in line with your OB, you can extend this line, then call it QML. QML stands for Quasimodo level. QML stands for Quasimodo level. So this is an area where you can catch your sniper entries. So you wait for the price to return to this OB, then you can buy. Then you can buy. So simple as that. Simple as that. QML, break of market structure, inducement. Then you buy. Then you buy. So let's do this. And then let's use the replay mode. You see? Take profit hit. Take profit hit. So when you are trading, make sure that you follow the steps that Rewill and Gagazon. Rewill, we have technical analysis, we have fundamental analysis, we have trading psychology, we have risk management. So when you buy at your OB, you apply risk management, because if you don't apply risk management, manipulation, it can take you out. Or when the price dips inside your order block, it can take you out if you don't apply proper risk management. And then your psychology is the one you can call the losses. If you have to put your stop loss, if you have to aim. your aim was to take out this liquidity. Indeed, price is a liquidity. You go out. Don't be greedy. Marketing. Don't be greedy. So after that, that's a basic smart money setup. You are out after the setup. So how to complicated what's kind of space marketing? Just identify a good order block, identify SH, identify break of market structure, liquidity zones. Then you want to set up your company. So I will show you all of those things they do repeat almost every day. So I got to go analyze the EU here. Let me analyze take check mo second na letso no kana ke bona gore nka se bone same. Check mo second na letso no na no, I have this one. No, this one is good. It's already nka irisa yona. So I have this one. So let's check it 15 minutes. We have this one. Since loader, but it's all right. Loader nka leka go itlhalosa since loader because ya bona. So we have what? We have this high and then this low. That's shift of mega structure. Shift of mega structure, you connect a higher high and then a higher low. That's shift of mega structure. And then the price drops towards the downside. Then we have break of mega structure. And then the other thing is that we have this zone, 1, 2. It's a zone near order block. When we have this zone near order block, we call it a QML, a quasi-model level. Then that's inducement. That's inducement. So after that, wait for the price to return to your order block. Look at the end. No loss, no drawback, no nothing. Just tap and go. Because of what? Because of this quasi-model level. Entry is a basic smart money setup. SMS, break of market structure, QML, inducement, sniper entry. You take profit, just this loss, at this loss, at this loss. So that's how you go on when you're trading these two setups. So the example is the mala gore le kgona go backtest le sa tseng mo dingalo ke setup tsa teng. Le kgona go backtest le sa tseng mo dingalo ke setup tsa teng. This one is now. So this setup is the same as Yapo V25 1S because we have what? We have this high and then we have this low. So this is SMS, shift of market structure, break of market structure, and then we have what? QML. So these schematics, they will always repeat more marketing. The price will repeat itself, always. So the same schematics, they repeat almost every day, which means if screenshot the schematic is easy because you know that the same schematics they do repeat almost every day. So this SMS, QML, break of market structure, return to OB, you sell. Look at this. Look at this schematic. Look at this schematic and relate it to So we have QML, SMS, break of market structure. Look at this drop. And then easy hella. So that's setup number 1 and setup number 2. Setup number 1, you go on SH, BOS, RTO. Setup number 2, you go on SMS, BOS, RTO. So with setup number 2, don't be worried because the most important thing is setup number 1. The most important thing is setup number 1 with confluences. Confluence is very important. Confluence is very important. So moving forward, Amy lesson here was to teach you about breaker blocks. Aim your lesson here was to teach you about breaker block. Breaker block is very simple. Breaker block is very simple. So breaker block is a failed order block. Breaker block is a failed order block. So if we have this scenario whereby we have 1, 2, 1, 2 break of structure, and then price when the price reaches this OB, we are supposed to buy. Because that's a basic schematic setup number 1. So we have SH here, and then we have break of market structure. And after that, we have our order block. And then the other thing we have, let's say we have inducement. So we have everything that you need in order to trade. You have SH, you have break of market structure, you have inducement, everything. So when the price returns to your order block, you place your orders here, the price manipulates, takes you out. So don't be afraid when you see something like this, because we are not market makers. So at some point when you are trading, you're going to make losses. So that's why as a trader, others are part of this game. So at some point you're going to make losses. So when the price manipulates your order block, if you don't apply proper risk management, you are out. So it's better when you trade and then you apply proper risk management. Because if you are risking at this position, you are risking 10% of your account. However, when we have, let's say $50, when you risk $11, or $15, $15, then the whole account still eating. But if price is an order block, or what we buy at the same time, what we buy order block, you are out. Your account is blue, 0-0. Your account is blue, 0-0. So it's better you apply risk management. Then when the price takes you out, then you realize, well, okay, this thing is a breakup block. You enter another trade. So if the price manipulates our order block like this, in order to trade a breakup block, we wait for the price to retrace back to this breakup block. Because when this order block fails to hold the price, it turns into a break. Turn to this breaker, then you sell. That's how you trade your order block, your breakup block. You can still add confluence. 1, 2, and then 3. Then you sell. 1, 2, 3, then you sell. That's a breakup block. That's a breakup block. So a breakup block basically just a failed OB. So breakup blocks, ga se go di dintsi mo marketing. Breakup block ga di dintsi thata mo marketing. So se le go se botlhokwa thata mo marketing is setup number 1. So se botlhokwa thata mo marketing is setup number 1. So let's try this. Let's try this example. Okay, so and then you can jump into line 15. So in this scenario, we have inducement. Clean 1. And then we have order block. The other thing we have SMS, shift of structure. Then we have break of market structure. We have everything. SMS, break of market structure, inducement, but still the price failed to sell at this order block. So we change this breaker block. We change this order block into a breaker block. So we wait for the price to retrace back to this level. Then we buy. Let's see. You can see. Price breaker environment. It has to enter to this breaker and then we buy. You see? Simple as that. That's a breaker block. You wait for the price to fail. You wait for the order block to fail and then wait for the price to retrace back to that OB. Then you enter as a breaker block. So that's a breaker block. So if you have any question you can ask regarding breaker blocks or anything that we like ask on today. If you have any question, breaker blocks, you can ask. Okay. So we can move forward. So it's either a breaker block or renally supply and demand flip. So yeah, gonna give a breaker block is a fake OB. So breaker block will supply and demand. Yeah, so we have 1, 2, 1, 2. This one is a break. 1, 2, 1, 2, 1, 2. Make a breaker block. This one is a breaker. And then supply and demand flip is whereby we have 1, 2, 1, 1, 2. So when the price approaches this order block, we're supposed to buy. So we have this order block. Then we have SH. Then we have SH here. Then we have break of market structure. And then confluence. We have everything. So when we buy at this order block, our take profit is supposed to be this high. But when the price is now buyer and then it drops towards the downside, it means higher for take profit and order block is not valid. So this one is not a breaker block because price is reacted before So in other ways, supply and demand. Supply is where we have aggressive buying, is where the price is aggressively buying, and then demand is where the price is aggressively selling. Demand and then supply. So when the demand fails to hold the price, now we take the supply. In other ways, supply is a bearish order block. Because that's where we have aggressive selling. So when the demand fails to hold the price, now we wait for the price to wait for the price to return to the supply, then we sell. So in this case, we're going to sell a price in the up. Wait for it for a guy. Etaha is inducement. Then wait for the price for a guy. Then you sell. So it's either price eta in this form or eta in this form. Breakup block, supply and demand flip. Supply and demand flip, price ya recta. Breakup block, price eta aggressive. Yes. So now let's dive into the chart. Let's go about the example, I think. Let's dive into the chart. Supply and demand flip. So this one I'm going to tell you that's what I want. Let's try this one. Let's try this one. Like say it's results. We have this aggressive move up. Break of mega structure. Order block. And then SH. SH, break of mega structure. And then 3G. 1, 2, 3. So because we have this, the price has to buy until this high. Pure prediction out the price is more up. And then price of it fades. It fades. So you don't give up because this is the demand where we have aggressive buying, and then price is now buyer, and then basically aggressive is guy at this point. So demand into supply. Our supply is here. That's our supply. From the supply zone, we have what? We have inducement. Wait for the price to return to the supply, then we sell. As we can see, so this is what we have: supply and demand, supply and demand. So so go and try back test, and then if so that's all for today.
Okay.